Tomorrow, market gets two key data points. The Fed's favorite inflation gauge, the Core PCE Price Index, and the University of Michigan's Consumer Sentiment Survey. These numbers could directly shift the Fed's September decision, and the markets are on edge. Welcome back to the Rod Reports, where money meets news. Don't forget to like, comment, and subscribe so you never miss data that drives the market. Let's dive right into it. Core PCE, the heavyweight of tomorrow's forecast, coming in at 0.3% month over month, the same as last month. Now, why does this matter? Coming in at that same rate, why does it matter? It's because this is the Fed's preferred inflation gauge. Unlike CPI, Core PCE captures the broader consumer behavior and better reflects Fed policy goals. Jerome Powell has said repeatedly that policy decisions will lean heavily on Core PCE and trends. Isn't that right, Powell? Yeah. So what does this mean for the market? How is the market going to be impacted? A hot print 0.3 tells us that inflation isn't easing. Bond yields rise as traders price in higher for longer rates. USD strengthens, especially against euro and yens. The NASDAQ and tech companies sell off because higher yields discount future cash flows, hitting growth valuations. Financial and energy often outperform this setup. And what happens with a cool print below 0.3%? That opens the door to a dovish pivot. Bonds rally, yields fall. The dollar weakens, lifting up commodities like oil and gold. Equities rally, especially NASDAQ, as traders pile into the rate-sensitive growth names. Then we have the University of Michigan's Consumer Sentiment, the featherweight, but it packs a little punch. The forecast is expected to come in at 58.6, unchanged. Why does this matter? Well, it's more about inflation expectations than a headline number. If consumers expect higher inflations over 1 to 5 years, it pressures the Fed to stay hawkish. If expectations drop, it reinforces the narrative that inflation is cooling. As many of you know, this rarely moves the market on its own. But a surprise jump in inflation expectations could spark intraday volatility in bonds, USDs, and equities. Weak sentiments reinforces slowdown fears, but it's bullish for defense sectors like utilities and staples. Now, I want to put it all together for you. What does this mean for the traders? What does this mean for investors? So I'm going to break it down in a couple sections. First, let's begin with equities. NASDAQ is the most sensitive. Watch tech names like Nvidia, Tesla, and Apple. The S&P's 500 will react, but the Dow is less exposed. Bonds. The 2-year Treasury yield is the barometer. Spikes higher on hot PCE, drops on a miss. Forex, USD JPY and EUR USD are the pairs to watch. Hot data equals strong dollar, weak data, dollar sell-off. And finally, commodities. Gold is the inflation hedge. Strong PCE, gold dips. Weak PCE, gold rallies. So here's the bottom line. Core PCE is the heavyweight to be watching for tomorrow. If it runs hot, Powell has every reason to hold firm, keeping pressure on tech stocks and lifting the dollar. If it cools, traders will jump on the rate cut hopes, fueling a rally in the NASDAQ and gold. The University of Michigan's survey adds color, but Core PCE is the one that will move markets. With that being said, that wraps up the end of this video. You've been watching the Rod Report, where money meets news. And if you found this helpful, don't forget to like this video, share your thoughts in the comment section, and subscribe so you never miss the next big data drop. And again, thank you guys for watching. I hope you guys make a ton of money on the markets tomorrow, and I'll see you on the next video.